Hello everybody, and once again welcome to Synonomics, the money machine. Today I'm going to start a new series of stock market for beginners, or the basics of stock market, or you can call it the basics of share investing, whatever you call it. The whole idea is basically to give the very elementary knowledge, the basic knowledge for the very young investors who want to join the market forces, who want to join the investment community. So I will start with very basic topics: that what is a company, what type of companies are there, what is share, how the shares are issued. I'll also talk about index. We always hear about the indices, right? Dow Jones Index, Nasdaq Index in the ASX 200 in Australian context, FTSE in London. In India we hear about Nifty 50 or Sensex. All these indices, what are they? How you can actually create your own index. So I'll teach you how to learn to create the indices. I'll talk about the price versus value. Price is basically what you pay and value is what you get. Then I'll talk about how to select the stocks. What are the ways to analyze? There are the fundamental analysis and there's a technical analysis. Fundamental analysis, you can actually look at the company's balance sheet, company's profit and loss statement and cash flow statement, and come out with some certain ratios like price earning ratio, price to book ratio, price to sale ratio, EV to EBITDA ratio, return on asset, return on equity, return on invested capital, etc., etc. I'll touch base on that as well and explain that. I'll also later on touch base on the technical analysis, and in fact I want to start a separate series of technical analysis where I will actually use the charts to explain what are the different type of charts: line diagram, whether it's a momentum chart, whether it's a moving average, whether it's a Japanese candlestick, whether it's a Heikin Ashi chart, and all of them. So stay tuned. I'm going to start a lot of educational stuff for the young investors, the investors who are Generation Z, Gen Z, or Gen Y, I would call that, right? Millennials. So, or even Gen X, who are not in the stock market. Well, without further ado, let me start with what is a stock market. Well, stock market is a place where the shares are traded. And today I'm not going to talk about the derivatives. I'll only focus on the stock, the shares. And what's the difference between the share and the mutual fund? So let's talk about the share. Before we talk about the share, we'll talk about the companies. So there are different type of companies. For an example, you start your own company. Many of you must be having it. Suppose you have your own company and you are the sole person as the owner. Your company will be called private company. Most of the time it will be private limited. Suppose your company is doing pretty well and now you need more fund. Either you can take fund from the bank or you can actually get another partner and get his contribution there, sell some of the shares to the partner. So I'll take an example here. Suppose you have opened a company, you have started a company of, I'll take a very small example just to explain it. Say it's $100,000. So the company you started with $100,000. And when you incorporate a company, you have to actually identify that how many shares are issued. Suppose you have issued shares of $10 each. So the number of shares issued for this company is 100,000 divided by 10. So it's 10,000. So you have actually issued 10,000 company shares, and the total value of your company is 100,000. Now You are expanding the company, guys, and you want some more funding to start that. Suppose you want to expand the branches, open another branch somewhere else. So either you can go to the bank and try to leverage it, take some loan. That's not considered a great idea. Maybe the bank may not give you. Maybe you have already taken loan before. So another approach is basically to get a partner. In this case, you can get another partner who can add another 100,000 there and buy 50% of the shares. So now your company became worth 200,000, and now the total number of owners or the partners are 2. Now this company has become partnership. Suppose you did very well and you think that it's time to kind of go public. Means now you want to raise fund from the public, and that's where the companies actually go to public. They issue this is called IPO, initial public offer, and then you will be selling some of your stock, some of your shares to the public. The normal process is basically some of the investment banker will evaluate the value of your company. They'll come out with a scheme. They'll say, okay, you can actually offload say 20% of your company and X number of shares, and the share price will be, we are going to offer that as an IPO price as $10 or $20 depending on the strength of the company and the number of shares issued. Once that happens, everybody will apply for that. If the company is good, everybody will apply for that in the IPO to get that share. Once that happens, the company has become public. Now it's public limited. Once the company has become public, you will have to follow the guides or regulations of the stock exchange or the Securities Exchange Commission of the different countries where you are operating. If you're in Australia, you have to follow ASIC, Australian Securities Institute Commission. If you are in USA, you'll have to follow SEC, Securities Exchange Commission. If you are in India, you'll follow SEBI guidelines, Securities Exchange Board of India, and so on. So every country has their own regulatory body to manage and regulate the stock market activities and the transactions. Once a company is listed as a private company, they have to follow those guidelines of the stock exchange. For an example, every quarter they have to publish their result because it's a public company now. Public wants to know. All your shareholders would like to understand how the company is doing. So you'll have to actually file that and announce your earnings report every quarter. And there are other restrictions as well, or regulations rather, which you'll have to follow. This is how the companies become public. Just to refresh your memory, initially it was a private company, then it became partnership, then it became public company. Once it has become the public company, guys, shareholders are also public. So if you are purchasing one share of a company, that means you are part owner of that company. Suppose the company has issued 1 million shares. I'm just taking a small example for illustration. And you have purchased one share, then you are 1/1,000,000th owner of that company. 1 divided by 1,000,000. That's your ownership of that company, guys. So as Warren Buffett talks about it, don't think that you're buying a ticker, you're buying a stock. You think that you're buying a company. And once you decide to invest, you should understand what you are actually purchasing, which company you want to buy, what the company does, how much profit the company is making. Do you have the right conviction to buy that company? And I have talked about it earlier as well. Is it in your circle of competence? Do you understand the company, understand the business? Very important. So that's about the companies. I'll talk a little bit about the price and the valuation as well. And I've talked about it. If you read Intelligent Investor of Ben Graham, one of the chapters is completely devoted on Mr. Market. He says that Mr. Market is something like a psychopathic guy, and he's your partner. Every day he comes with a price to sell his share to you. So I'll strongly recommend you to go and at least read that chapter of The Intelligent Investor. Well, same thing happens. The market keeps fluctuating up and down. There are two forces actually, the bear and the bull. The bull are the investors who are buying the stock to think that the stock price will go up. The company has good prospects and they are buying with the conviction or the bias that the stock price will go up. On the other hand, the sellers, the bears are the one who thinks that the stock price will go down. That's why they are selling it. They think it has peaked, the price has peaked, now it will go down, so they are selling it so that even if they have to buy later, they can actually buy at a much lower price point. They are called the bear and the bull. When the market continuously goes up, it's a bullish market. When the market is going down, it's a bear market. There has been some kind of yardsticks to measure that. If the market drops by 20% or more, they say, okay, the market has already collapsed. There's a crash. If the market continuously declines over a long period of time, it's pretty much in the bear market. Whereas if the market continuously goes up, it says, hey, the market is having its bull run. For an example, if you look at US market now, it's pretty much in the bull run. Dow was almost at the record, very close to the record high. Nasdaq has pretty much moved ahead. And if you look at India market, it's pretty much on the record high. It has crossed 20,000. Right now it's sitting at around 19,700, but actually it crossed 20,200. That's a new record high. It actually created last month. And this run has been continuously going up. Even though if you look at from the overall 2-year perspective, Indian market has not given much return. It had actually hit 18,600 in something like 2021 October. The whole 2022 was a washout, and 2023 it has now crossed that. So if you take that as the basis and look at for the last 2 years, guys, it has only given you 6-7%. But having said that, it is pretty much at the record high, and many of the stocks are going up, and that's called the bull run. So that's the balancing force. That's the balancing force in the market, bull and the bear. Otherwise, if everybody becomes bull, who is going to sell? And if everybody becomes bearish, the market will crash. Everybody will be selling. So that balance is actually created by that. I'll actually stop here because I don't want to actually lengthen the video too much. I want all of you to understand and digest this. In the next episode, I'm going to talk about the index. What are the different types of indices that we track in the different countries, in the different markets, how you can create your own index. Not many people know about it. Please let me know in my comment section here that do you know how to create an index? For an example, you want to create an index of your own portfolio. You want to create index of the vegetables you purchase. You want to create the index of the fruits you purchase. Can you do that? Please let me know in the comment section. I'll be really interested to know that. And also later on, I'll talk about how to select a company. What's the criteria for stock selection, both for the novice, young investors, and also for the professional investors. Because we all do mistakes in that. We all are learning. We are pretty much in a learning journey, guys. Market is a great guru. It's a teacher. It teaches you throughout your life. But there are some proven facts I will actually talk a little bit about from whatever I have learned from my gurus, and based on my own experience, I'll talk about that. How to select a stock, how to create a portfolio, a good portfolio that will give you return in the longer term. And all these are actually called asset allocation. How you can allocate your assets. So I'll talk all of that in my next episode. If you like this kind of content, please don't forget to like, share and subscribe. Synanomics is out there to create financial awareness so that you can understand the companies you are interested in, analyze them before you purchase, and make money by buying them. All the companies and the stocks that I talked about are pretty much for the references only. They are my personal opinion. I may be having some interest in those. So don't forget to consult your financial advisor before making any investment decisions, guys. With that, it's a goodbye from your finance coach, Pankaj Sinha. Bye-bye.